We had a low interest rate environment which made life very easy for borrowers, asset owners. It was easy to run a business. The economy did well. We had the longest bull market in history, the longest economic recovery in history. We had very low incidence of default and bankruptcy. It was an easy world. And if you read articles about, for example, Silicon Valley Bank, they talk about the easy money environment. And the main point of sea change is we're no longer in an easy money environment. And the Fed funds rate was zero, probably the majority of the time in the 09 to 21 period. And that's inappropriate. It stimulates. You can't live on a shot of adrenaline every morning for 13 years. If you came into this business since 1980, which is almost everybody, you have only seen declining interest rates or ultra low interest rates. People tend to say, well, that's what it's been for 40 years, that's normal, that's what it's going to be. But no, you have to recognize, that's why I call this sea change, because you have to recognize this is an important pivot. Some people come up to me and say, yes, you're right, interest rates are low. Nobody has said this is a major change, as you say it is. But, you know, if it's the change I think it is, then what you should have in your portfolio going forward can be very different from what it has been. And so far, I have not had resounding support for that position. This period of 09 through 21, easy period, easy to get money. So most bankruptcies don't occur because you have a business and it loses money, goes away. It occurs because a business borrows money, times get tough, and when it goes to refinance that loan, nobody ever repays their debts. They just refinance it. And when they go to the bank to refinance it, the bank says, you're not as good a credit as you used to be, or we don't have as much money to lend as we used to have, or our standards are higher. So it really comes from most bankruptcies or defaults are associated with a maturity which is unmet. And I think that when you go through a period when it's super easy to raise money for any purpose or no purpose, and you go into a period when it's difficult to raise money even for a good purpose, clearly many more companies are going to founder. The long-term average default rate on high-yield bonds, for example, is close to 4% for the last 45 years. We didn't have any years in the last 15 at 4%. It was a very low period. In the coming years, there will be some. The way I sum it up, I say, you found a company to buy, you went to the bank, they said, we'll lend you $800 million at 5%. Now the loan is up for renewal, you go in, they say, fine, we'll lend you $500 million at 8%. So you have less money and your cost of capital is higher, and you have a $300 million hole that you can't fill. There's never been a bankruptcy of the US or a country like it, so we don't know what's going to happen. Right now, the US dollar is what's called the reserve currency of the world, and we get to print them. In the short run, we can print as many as we want. And as long as that's the case, we're not going to go under. It's like if you have an unlimited checking account, you can pay your credit card bills without limitation. We just don't know where it's going. That's the problem. Using a default as a negotiating tool is very, very dangerous. But it's the golden goose. We have this reserve currency status because the dollar is the safest currency in the world and the US economy is the best. Why would you jeopardize that? I wouldn't tell anybody what they should do. What I would say is this: investing is a fascinating field because there are so many variables that have to be juggled and so many uncertainties that have to be dealt with. It's stimulating. The solutions are never static. Yesterday's solution will not work tomorrow. It keeps you on your toes. On the other hand, because of the imprecision, you fail a lot. The great investors are right 60%, 70%, maybe 80% of the time. If you're the kind of person who has to be right all the time, you shouldn't be in investing. People believe in the ability to predict the future, either their ability or others that they can identify. And in general, I agree with John Kenneth Galbraith, who said there are two kinds of forecasters, the ones who don't know and the ones who don't know they don't know. So I think that the average person has to learn that they don't know what the future holds, and nobody else does either. The other thing is, people believe that there's kind of a direct and mechanical linkage. If a company has a good event, the securities do well. If they have a bad event, like earnings, securities do poorly. But that's not the case, because there's a intermediate step, which is people's reaction. So it's not just whether the event was positive, it's how people reacted to the event that determines the impact on the security prices, and that's two different things. So you can't forget the psychological and human factor. You know, I received snippets from hanging around with smart people. I didn't have a single mentor. I read a lot, and I was fortunate to associate with people who were generous with their knowledge and shared it with me, and that's why I write the memos, to share it with others.